Hello, in today's series, let's find out if we are already in the midst of an upcoming recessionary storm. Before we begin, it is worth mentioning that Warren Buffett, the world's greatest value investor, is finally retiring at 94. Warren Buffett said last Saturday at a Berkshire Hathaway's annual shareholder meeting that he would step down as CEO by the end of this year. Greg Abel, who is currently vice chairman of Berkshire, would take over at that point, pending the board's approval. And Buffett said he would not sell one share of Berkshire stock upon his retirement. Buffett will still remain as chairman before turning that role over to his son, Howard Buffett, upon his death. Therefore, does Buffett know something we don't? Perhaps a storm and a long winter for the stock markets? Despite a dip in earnings attributed to wildfire insurance payouts and concerns over potential tariff policies under Donald Trump, Berkshire Hathaway is sitting on a massive $347 billion cash pile. This significant reserve persists after the company continues to divest $4.7 billion in stocks during the first quarter of 2025. In the past month, we see that the S&P have already rebounded from its low and gained 5.38%. Is this the calm before the actual storm? Should we still buy stocks if indeed we believe that a storm is coming? Hello everyone, welcome back to SDA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high quality tutorials, guides and insights that demystify the world of trading. Join us as we will share more trading secrets and valuable insights. To stay updated and to be the first to access these valuable resources, hit the subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing your potential for success. Before we dive in, here's a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. So, what are the three indicators I use to identify that a likely storm is near? They are GDP growth, unemployment rates, and manufacturing output. The first thing we now look at is the US GDP. So, what is the US GDP made of? The US Gross Domestic Product, or GDP, is a comprehensive measure of the total market value of all final goods and services produced within the United States during a specific period, typically a year. It's a key indicator of the nation's economic health, reflecting the size and growth of the US economy. The latest first quarter US GDP data shows a decline by 0.3%. This decline is primarily due to a decrease in consumer spending and a downturn in government spending, but was partially offset by investments and exports. Another indicator to look at will be the non-farm payroll, which refers to the number of employed people in the United States, excluding those in agriculture, private households and non-profit organizations. It's a key monthly indicator of the US labor market, reflecting the number of jobs added or lost in the economy. The total non-farm payroll employment increased by 177,000 in April, and the unemployment rate was unchanged at 4.2%. Employment continued to trend up in healthcare, transportation, warehousing, financial services, and social assistance. The average unemployment rate in the US was 5.68%, calculated from 1948 to 2025, while the unemployment rate peaked at 14.2% in 2020 during the COVID period. The latest data in the non-farm payroll indicates that employment in the US is still going strong, and unemployment is still below the long-term average. However, employment data could indicate some lag, and we would need to see employment data in the next half of this year to determine stability. The final indicator I will be looking at is the manufacturing output. So, what does the PMI or Purchasing Managers Index measure? The PMI is a monthly economic indicator that gauges the health and direction of the manufacturing and services sectors. It's a diffusion index, meaning it summarizes whether the market conditions are expanding, contracting, or remain the same, based on the views of purchasing managers. A PMI reading above 50 generally indicates expansion, while a reading below 50 suggests contraction. The US PMI currently registered a 48.7% in April, a 0.3 percentage point lower compared to the 49% recorded in March, indicating a contraction. In April last month, US manufacturing activity slipped marginally further into contraction, after expanding only marginally in February. Demand and output weakened while input strengthened further, indicating conditions that are not considered positive for economic growth. As we are now back into US earnings season again, we will need to see how the majority of US businesses perform, including the US banks. According to JP Morgan, the likelihood of a recession by end of this year has been increased from 40% in March to 60% by the end of April due to Trump's aggressive tariff policies. Based on the data above, in my own opinion, a technical recession could be likely, but I do not see a doom and gloom situation that will put us back into the era of the Great Depression, provided President Trump is able to negotiate favorable deals with major trade partners going forward. Good stocks to look at now would be defensive stocks like the blue chip Singapore REITs and FMCG businesses such as supermarkets. My favorite Singapore REIT would be CapitaLand Ascendas REIT, and for FMCG would be Sheng Siong. The reason for this is because Singapore REITs like CapitaLand Ascendas REIT has a well-diversified portfolio and currently pays a dividend yield of 5.72% and is trading at a PE of 15 times, while Sheng Siong, which is one of Singapore's leading supermarket chain, pays a dividend yield of 3.64% and is trading at a PE of 18 times. Therefore, these stocks could be considered defensive as they are less likely to be sensitive to a global trade war and still pay decent dividend yields of 5.72% and 3.64% respectively, which are better than most fixed deposit rates. Goodbye and see you in my next video.